Welcome in video 3 of life insurance benefits. In the previous two videos, we considered whole life insurance benefits and term life insurance benefits. Now we will consider deferred life insurance benefits. What is a deferred life insurance benefit? We consider a deferred term insurance benefit. Term insurance underwritten on a person of age X at time 0 with payments of 1 at time Tx. So at the moment of that, there is a payment, provided now Tx is between U and U plus N. So if the insured dies in the deferred period that starts U year from here and that has a duration of N years. So there is a payment of 1 at the moment of death if the insured dies in this period here. The benefit cash flow is then equal to, at the moment of that, there is a Bernoulli payment, which is 1 only if Tx is between U and U plus N. Well, here one says that Americans overestimate the cost of life insurance by 3 times. I don't know if it's 100% correct, but in any case, it's very difficult to estimate the cost of a life insurance contract. And the reason for that is partly explained by having a look at this cash flow. If you look at this cash flow, the cost of this cash flow, the actuarial value of this cash flow depends on X, U, and N. It depends on your age, on the deferral period, and on the duration. For a fixed age, the later the more you defer the insurance, the cheaper. And also, the longer the duration of the insurance, the more expensive it will be. And in general, if not for a given age, for higher ages, a life insurance will be more expensive than for younger ages. So it's extremely hard to estimate, to have an idea about the cost of such a life insurance contract. Well, we have our benefit cash flow for the U-year deferred insurance, and it's a term insurance with a term of N years. We calculate the present value of this cash flow, and this is the Bernoulli variable multiplied by discount factor e to the power minus delta Tx, and then we take the expectation of this random variable, of this present value random variable Z, to get the single premium. So what we get is in fact a similar integral as what we have seen before, but now you integrate only in the insurance period, so between time 0 and time 0 plus time U and time U plus N, because if our remaining lifetime is not in U plus N, the payment is 0. And we have a notation for such an actuarial value. We denote that by U bar A X1N line. U bar means that insurance starts U years later. The A stands for insurance, X is the insured, and X has to die in the insurance period before the end of the insurance period of N years to get a payment of 1. And then we have a number of special relations, interesting relations that we will have a look at hereafter. First of all, the relation between deferred in term insurance and actuarial discounting. This is here the single premium for a U-year deferred insurance of duration N. This can be seen as the single premium for an insurance on a person of age X plus U for N years, but multiplied by EXU. And EXU is then called the actuarial discount factor. Let us have a closer look at this relation. So we have this U-year deferred N-year term insurance. This is in fact this symbol here is the expected present value of a series of cash flows. And what are the cash flows? There are payments. There is a payment 1 at time U plus 1 possible if the condition KXU is satisfied, and so on until the last possible payment is at time U plus N. There will be a payment of 1 at time U plus N, provided the insured dies in the preceding year. So again, our This here is the actuarial symbol of the expected present value of this series of cash flows. But let us now again have a look at this cash flows, but in another way. These cash flows are in fact equivalent with the following. Suppose that the insured is still alive at time U. So suppose that we are here at time U and the insured is still alive. What he will get then is all these possible random payments over the next n years. So that is in the actuarial value of this. That's an insurance, a life insurance on a person of age X plus U for the duration of n years. But he will only get this amount, or this is only the actuarial value of his future payments at age U, if he is still alive at age U. So we have to multiply by 1 provided the X is larger than U. Suppose that the insured has died at time U, then the future liabilities are just 0. So only looking at the expected present values, we could say that this cash flow here is equivalent with a cash flow at time U, and this cash flow equals to the single premium of the life insurance, the n-year term life insurance on the person of age X plus U for a duration of n years. So we replace the series of cash flows by one cash flow at time U, which is a random cash flow, and the randomness is in the survival of the insured at time U. Now this expected present value can easily be calculated. We discount first, so that's the A X plus U 1n here, multiplied by 1, provided Tx is larger than U. We discount that 2 times 0, so we multiply by V to the power U, and then we take the expectation. The expectation of the indicator variable is nothing else than probability that X is still alive at time U. And we have already a notation before for this Pxu multiplied by V to the power U. That was the single premium of a pure endowment insurance, so EXU. So in the end, we come to formula 4.22, which says that the U-year deferred life insurance is in fact an immediately starting life insurance at age X plus U, but discounted to age 2 times 0, to now. So if we have a U-year deferred term insurance, we can just place ourselves at age X plus U and evaluate what is the liability then. The liability at that time will be AX plus U and this value here, provided the insured is still alive. So this is only in the case the insured is alive that this is due. So we have to discount not only by interest, but also by survival. We have to discount by EXU. That's why EXU is called the actuarial discount factor over the period 0U. Still, one small remark. We call this exercise, formula here 4.22 prime and not 4.22, because here in 4.22 it's a continuous case that is considered, while here in 4.22 prime we consider the discrete, the yearly case. Let us then also have a look at relation 4.23, which we will prove or give an intuitive interpretation in the discrete setting. So we have here again a life insurance which is U-year deferred and which has a duration of n years. So this symbol here is in fact the actuarial value or the expected present value of a series of cash flows. What are the cash flows? The cash flows are possible ones at the end of the year in case you died in the previous year, in this blue area, in this blue time period. So you are insured for the blue time period. If you die somewhere in this blue time period, then at the end of the corresponding year, you get 1. Now, it's easy to see that the blue time period can be written as the time period. So the blue time period is the period between U and U plus N, can be seen as the time period between 0 and U plus N, but then we have to correct, we have to subtract this period 0U. So the blue time period is this green time period minus this time period. If we express this in terms of expected present values, we get here this here, the expected present value of this series of payments is in fact a life insurance on a person of age X for a duration of U plus N years. That's this first part. Minus then, and what is this? This is a life insurance on a person of age X for U years. So we get that the U year deferred insurance is the immediately insurance period, is the actuarial value of the U year deferred insurance, is the actuarial value of an immediately starting insurance for a period of U plus N years, but then we have given too much, we have to take back the first payments, the payments for the first U years. That leads to 4.23 prime. And then there is another exercise, 4.24 prime. Again, this is, we call it the prime number because in the formula in the book is 4.24 for the continuous case, while here we consider the yearly case. So we have now this immediately starting insurance for a period of N years on a person of age X. So you are insured now in the blue period. You are insured for the first N years. You get a Bernoulli payment, which is 1 if you die in the previous year. Now, the insurance for the N year period can be written as the insurance for the first year, plus insurance for the second year, plus an insurance for the last year. So we split the N year term insurance in N 1 year term insurances. And if we calculate then the actuarial values of each of these 1 year term insurances, we get indeed the first line here, that's an insurance for a duration of 1 year that immediately starts. If we have a look at the second line, that's an insurance for a period of 1 year, but that only starts in 1 year. And then the last here is an insurance, again, only for 1 year, so AX1, but it only starts in N-1 years. So these are now, we have given intuitive interpretations, in fact, for these three relations. For the mathematical proof of these three relations, have a look in the book. The intuitive or actuarial interpretation is given in these pictures. Now there are some more expressions that we can derive. First, the deferred term insurance in terms of yearly insurances. This expression is now, we have a U-year deferred N-year term insurance. We split it as N 1 year term insurances, but deferred 1 year term insurances. This is in fact a generalization of formula 4.24. Then we have a whole life insurance in terms of yearly insurances. A whole life insurance can be written as a sum of deferred 1 year term insurances. This is a special case of 4.24. And finally, there is also this expression AX1N. So the cost of a N-year term insurance immediately starting can be written as AX minus AXN bar. So it can be written as a lifelong life insurance minus an N-year deferred life insurance. And this can also be written as a lifelong life insurance on X minus the discounted value, the actuarially discounted value of an insurance starting at time N on a person of age X plus N. Let us have a look at an interpretation of this formula 4.25. So we start here with the symbol for the N-year term insurance. And this N-year term insurance is, or this single premium, is the actuarial value of a cash flow that pays Bernoulli outcomes, Bernoulli amounts 0 or 1 in the period 0N. Okay, so the payments in the period 0N can be written as lifelong payments. Here I pay you 1 if you died in the year before, lifelong. But then I have to correct with this part. All the payments after time N, you have to give it back. So being paid 1 if you die in the first n year is being paid 1 lifelong minus giving back the premium, the payment of 1 in case you die after time n. So if we express this in terms of actuarial values, we have that the n-year term insurance is a lifelong insurance minus an n-year deferred insurance. And this n-year deferred insurance can then be written as AXN multiplied by AX plus N. That's something that we have seen before. An n-year deferred insurance can be seen as an insurance on a person of age X plus N, so n years later, immediately starting then, but provided you are then alive. So we have to discount with the actuarial discount factor. Now let us look at the relation between the continuous, discrete, and the monthly cases, let's say. Suppose that there is only an integer life table available, so we have only the symbols, we have only expressions for integer ages. So we only have the L0, L1, L2, L3, or we have only values for this AX. We only have values for instance, the single premium of a life insurance on a person of age 40, 41, 42. But now what we want to do is we want to determine AX4. So suppose that we want to pay at the end of the 3-month period that you die. How can we determine this given that we only have values, life table values, let us say, for integer ages? Or how can we determine the single premium for a continuous life insurance contract given that we only have values for survival and death at integer ages? Well, first an observation. Let us have a look at the ratio AX4 divided by AX. So the cost, the single premium of a life insurance that pays at the end of the 3-month period divided by a discrete, by the single premium of a life insurance that pays at the end of the year of death. And let us also look at the same, or a similar ratio of AX bar divided by AX. If you look here for different ages at these ratios, you will see that these ratios are quite stable if the age is not too high. And what we want to do now, we will derive an approximate value for these ratios. So if we know AX, how can we calculate approximately AX bar? Well, this is expressed here. We will do that using the uniform distribution of death assumption. The uniform distribution of death assumption is an assumption that we introduced for mortality during the year. And this could be expressed as follows. For any integer age s and any value s between 0 and 1, we assume that QYS, so the probability, for instance, that a person of 40 dies after 3 months, S is 3 over 12 then, multiplied by Q40. So we assume that there is a uniform mortality over each year. And as a consequence, we found then, for instance, formula 3.11, that QY, the probability that a person of age Y with Y an integer, can always be written as PYS multiplied by mu I Y plus S for any S in 0, 1. Then you find in the book there is a proof of the following relation. The continuous case AX line under the uniform distribution of that assumption can be written as I over delta times AX. So if you want to determine AX line, in fact what you have to solve is an integral. And in an integral you need to know mortality over all ages, not only integer, over all possible outcomes of Tx. Well, you can, under the uniform distribution of that assumption, it is equal to I over delta times AX, where this AX is an insurance that only pays at the end of the year of death. So that means that this AX is here a sum, and only this present actuarial present value is a sum, and this sum only requires survival at integer ages. The same holds for the monthly case or the 1 over monthly case. There you can prove, and try to prove this by yourself or find to prove in the book, AXM under the uniform distribution of that assumption can be written as I over IM, or is equal to I over IM multiplied by AX. So we assume that we only have mortality and survival for integer ages, but we want to calculate continuously or 1 over empty cases under the uniform distribution of that assumption. That's very easy because we can transform everything, or it can be expressed, the single premium can be expressed as a function of insurances that pay at the end of the year of death. And for these insurances, we only need integer mortality and survival. Then, what about the endowment insurance? The endowment insurance is an insurance that pays 1 in case you die in the first n years. At the moment that you die, you get the payment 1. Or if you survive after n years, then you get the 1. So you get the 1 in any case. At the moment that you die, if you die before time n, at time n, in case you are still alive at time n. Well, you can then easily prove that under the uniform distribution of that assumption, we have that this can be written as I over delta times the insurance, the term insurance for the yearly case plus EXN. Now, there is another way also to relate the continuous, the discrete, and the 1 over empty case using the claims acceleration approach. You can read this in the book, but this section 4.5.2 is not a part of the exam. Now, let us have a look at variable insurance benefits. Until now, we always assumed that our life insurance benefit remains constant over the whole duration of the insurance. In reality, sometimes we need insurances, life insurances, where the payment at death depends on the time where you die. For instance, if you want an insurance against your salary loss at death, I want an insurance that pays if I die, my future salaries that I will lose. Well, the future salaries that I will earn, they decrease over time, of course. So if I want to have an insurance against my future salary loss, it should be a life insurance with a decreasing insured amount, decreasing over time. If I want an inflation adapted benefit, for instance, the benefit that I want should be adapted to inflation. For instance, it should, if I die in the first year, I want 1. If I die in the second year, I want 1.03, assuming an inflation of 3%, and so on. Another possibility, an insurance linked to a mortgage loan. We will come back to that in a couple of slides. So if I want to be insured against the remaining debt of my mortgage loan, this remaining debt over time will decrease. So the insured amount should also decrease. And then another example is something that we will see later in the chapter on premiums. Sometimes there are life insurance contracts with yearly premiums, but with an additional guarantee that if you die, you get all your premiums that you paid back, you get them all back at death. So you pay premiums yearly. If you die after 10 years, you get your 10 premiums back. So in that case, you also have a life insurance that pays you in the first year the premium, in the second year 2 premiums, in the third year 3 premiums back. So that is also in life insurance with a variable insurance benefit. These are just examples of variable life insurance benefits. Let us look a little bit at some special cases. So we consider life insurance underwritten on a person of age X at time 0 with a payment of Tx at time Tx. So if a payment that you will get is exactly the number of years that you're still going to live. So from time 0 C, it's a random amount that you will get at a random time. You will get Tx at time Tx. If we want to calculate the actuarial value, as always, first we take the present value. So the present value of your payment is Tx times e to the power minus delta Tx. And then the actuarial value of it is then the integral of this function of Tx. You have to, the expectation of this Tx e to the power minus delta Tx, or that's the expectation of a function of Tx. And it's easy to verify that the expectation of this function of Tx is given by the integral given in 4.32. We have a notation, an actuarial notation for such an actuarial value, we will denote that by I overlined A overlined X. The X stands for the age of the insured at policy issue. The A stands, it's a life insurance with payments at death. The A overlined means that the payment is at the moment of death. And the I overlined, the I stands for increasing, the payment is increasing, and I bar, I overlined means it's continuously increasing. Indeed, the payment is TX at time TX, so it's a continuously increasing life insurance with payment at the moment of death on a person of age X year old. Now, let us have a look at some interesting examples, yes. Example 4.6, we consider a term insurance is issued on a person of age X with the following benefit cash flow. At the end of the year of your death, you get KX plus 1, so the number of years that you have survived plus 1, but only if you die within the first N years. So if you have a look at the timeline, here we have below we have the time, and above we have the death benefit. If you die in the first year, you get 1 at time 1. If you die in the second year, you get 2 at time 2. If you die in the nth year, you get N at time N. This is the description of the cash flow. And then we can calculate the expected present value of this cash flow. The expected present value of this cash flow is then very simple. It is take first the present value of the payment. So suppose that you die in the year K plus 1, then you get K plus 1. The discounted value is V to the power K plus 1. So V to the power K plus 1 multiplied by K plus 1 is the discounted value of what you get when you die in the year K plus 1. And the probability that you die in the year K plus 1 is QXK bar. So that here, V to the power K plus 1, K multiplied by K plus 1 multiplied by QXK bar is in fact the cost of being insured in the year K plus 1. But now you're not only insured between K, not only insured for that 1 year, you're insured for any of these years where K goes from 0 to N minus 1. If K is N minus 1, we are talking about the year N minus 1, N, which is the last year of the insurance. And this cash flow is denoted by IAX1N. So the insured X has to die within the next N years, and the A is not overlined, so that means there is a payment at the end of the year of death. The I is not overlined, it's not continuous, the increase is only 1 per year. Okay. Now, example 4.7. Now we consider an insurance issued to a person of age X with the following cash flow. You get KX4 plus, you get at time KX4 plus 1 over 4, KX plus 1. So what does that mean? We split the years in 3-month periods, in 3 monthly periods, and you get a payment at the end of the 3-month period in which you die, and the amount of money that you get is the number of years that you have, whole years that you have survived, plus 1. Okay. Then you can show, well, let us first have a look at how this payment looks like. So we have time 0, time 1, time 2, and we split the years in 3 monthly periods, in 3-month periods. So we have 1 over 4, time 1 over 4, 2 over 4, 3 over 4, 1, and so on. If you die in the first 3 months, you get 1 after 3 months. If you die in the second 3 months, you get 1 at the middle of the year. If you die between month 6 and month 9, you get 1 after 9 months. And at time after 9 months from the start of the insurance, of course. If you die in the last 3 months of the year, you get 1 at the end of the year. This story repeats, but in the second year, it's not about a payment of 1, but it's a payment of 2 when you die, and so on. This is the insurance that we have considered here in examples 4.7, and then have a look at this exercise by yourself to show that the expected present value of this cash flow, as we denoted here, as we expressed here, is indeed equal to this infinite sum. Then we come to example 4.8, which is a very interesting example, because here we consider an term insurance where you want to have a payment from year to year that is adapted to the inflation. So we consider a term insurance issued to X with the benefit cash flow given by this. So at the end of the year that you die, you get 1 plus j to the power kx multiplied by this indicator variable. So that means you only get a payment in case you die in the first n years. It's in term insurance, n-year term insurance, and the amount of money that you get depends on the year that you die, and we take into account inflation. Let us have a look at the possible payments. So the payment at that is as follows. If you die in the first year, you get 1. If you die in the second year, you get 1 plus j. If you die in the nth year, you get 1 plus j to the power n minus 1. So that means that we assume an inflation of j per year, for instance, j is 3%, and we adapt that benefit, that payment to the assumed inflation. Once you have done that, how can we now calculate the actual value or the expected present value of this cash flow? Well, this is an interesting example which you have to study by yourself, but please have a look at it. You can show that this cash flow or the actual value of this cash flow with variable benefits can be written as the expected present value of a cash flow with a constant payment. That looks like a trick or like magic, but it is not. What happens? You have to show, you can show that this cash flow, its actual value is 1 over 1 plus j times the cost of a term insurance on a person of age X for n years with a constant payment, so with a payment of 1 over 1 plus j in case you die, but with a new interest I star. And what is the new interest I star? It's 1 plus I divided by 1 plus j minus 1. And what is the AX1 and I star then? It's in fact indeed the single premium. This is the single premium of an n-year term insurance, which pays 1 if you die in the first n years, and the interest is not I, but I star. So again, what we can do, we have here a term insurance with a variable benefit. We can express its actuarial value as the actuarial value of a n-year term insurance with constant benefit of 1 plus j, but we have to adapt the interest I in I star. So the I star has no meaning, it's just a trick to be able to express this actuarial value of a complicated product into something simpler that we know already, namely the expected present value of a constant term insurance. And then example 4.9 is in fact a similar example, but now we assume a continuous setting. So we assume that at the moment that you die, provided this death happens in the first n years, you get 1 plus j to the power tx, where j is a deterministic amount, which is an assumption for us for the inflation. This is a continuous parallel or the continuous equivalent of example 4.8, which was a discrete case. Again, you can show that the actuarial value or the expected present value of this cash flow is given by the actuarial value for an n-year term insurance, a continuous n-year term insurance with a constant payment of 1, yes, but with an adapted interest of I star, where I star is again given as before. A very important example to have a close look at. And then let us now say something about this term insurances linked to a mortgage loan. Suppose a person X borrows an amount D0 at time 0 at an interest J. So I'm going to the bank, I want D0 is 100,000 euro, and the bank charges me an interest of, let's say, 2%. This is a debt towards the bank, and it has to be repaid by repayments, and we assume that we pay back once per year. So we pay at times 1, 2 to n, we pay something back of the loan. So each pi k is in fact consists of two parts. It's a sum of the interest payment, so of the remaining debt. There was something that you still have to pay, that you still have as a loan from the bank. It's called the remaining debt. You have to pay interest on that, and the extra that you pay is for the reduction of the amount that was still with the bank. Well, let's have a look at the recursion that expresses this remaining debt. Let dk be the remaining debt at time k, k is 1, 2 to n, before payment of pi k, so before we pay the repayment at time k. What recursion holds between this remaining debts at different times? Okay. We start with the remaining debt at time k minus 1. It's dk minus 1. And this was dk minus 1 before payment of the pi. So then we pay pi k minus 1. So the remaining debt after having paid pi k minus 1 remains dk minus 1 minus pk minus 1, pi k minus 1. You keep this with the bank for another year, and the bank charges you an interest j on that. So we have to multiply by 1 plus j, and then we get the new remaining debt at time k before you make the new repayment at that time. There are some initial and terminal repayment conditions. Pi 0 is 0. That means the bank gives me D0 is 100,000 euro at time 0. I don't start to pay back immediately already at time 0. And a last condition, the final condition is pi n is the n. Pi n is the last payment I'm doing to the bank. Well, if at time n I have still a remaining debt of dn, I have to pay the whole dn at time n. So to give an overview of what is happening now, so I'm going to the bank and they give me D0. With the recursion, we can calculate that after 1 year, there is an amount D1 that I have to pay back to the bank. Then I pay pi 1. Based on this D1 is pi 1 and the interest that the bank is going to charge me, there is a remaining debt D2 at time 2. Then I pay a premium P2 and so on. This continues until there is a payment dn left to be made to the bank. And this last dn is paid by my repayment by n. Now, what is a term insurance linked to the mortgage loan? Suppose now that in one of the years I'm dying, then, for instance, I die in the second year, then D2 still has to be paid. At the end of that year, D2 is the amount that I still have to give to the bank, or my loan at that moment, that my remaining debt, better, is D2. So now I want an insurance to protect the people of my family, that if I die, I don't want that they have to pay further the loan. So if I die, I want that the remaining debt is paid to the bank by the insurance company. Therefore, I can buy the following term insurance. I buy a term insurance for n years. If I die in the first year, then the insurer gives D1 to the bank, and my family doesn't have to pay back, doesn't have to pay anything anymore related to the loan. The loan is completely paid back. If I die in the second year, then there is a remaining debt at the end of that year of D2, and this term insurance will pay the D2 to the bank. And this until time dn. So the term insurance covering the remaining debt, the single premium for such an insurance should be, it's a sum of 1 year deferred term insurances. If I die in the year k plus 1, then I need an insurance k year deferred for a period of 1 year that pays me dk plus 1 at time k plus 1. So this is a term insurance linked to a mortgage long. Now, in this chapter, we didn't talk so far about select lives. So we developed results in terms of lives subject to ultimate mortality. We were always using life tables with a single entry, age. We didn't talk about time since underwriting of the policy. Well, all what we have developed so far in this chapter can also be applied to lives subject to select mortality. For instance, suppose that we want to calculate AX, that's a single premium of a whole life insurance on a person of age X who underwrote this contract just now at age X, and he wants one at the moment that he dies. Well, you can write that this AX, the actuarial value of it, or the expected present value of it, is similar as the formula that we have seen, but we have to take into account on the right-hand side that the X has to be between brackets here and here. Important is, if we have formulas like this, if on the left-hand side it's the X that is between brackets, it means the person X underwrote the policy at age X. Then also on the right-hand side, wherever you see an X, this X has to be between brackets because it's the same person, and this person has underwritten the insurance contract at age X. Or another example is this one here, AX plus S1N. What is this? This is an N-year term insurance on a person of age X plus S who underwrote S years ago. Or better, this is the actuarial value of the future payments related to an N-year term insurance of an X-year plus S-year-old person who underwrote S years ago. So the insurance consists already S years, and it remains still for another N years. What is now, at this moment, the cost, the value of the future liability? Well, you can write this as a sum of a number of terms, which if the X plus S year old person dies with a deferral of K years, then at that time, there will be a payment of 1, so discounted value of V to the power K plus 1. At that payment will be due at time K plus 1, and we have to sum over N years. So again, here the X is between brackets because that means that this was the underwriting age for the person age X. Here the X also has to be between brackets because it's about the same person. There are some notes and further reading in the book. Just read this, and thank you for your attention.